What if I told you that a single decision, made in a closed room in Washington, D.C., could send the price of everything from your Amazon stocks to the gold in your safe soaring? That the very money in your bank account could be on the verge of losing its power faster than you think? That decision is coming, and it's almost a guaranteed certainty. Welcome, everyone. In today's crucial video, we're not just talking about a potential interest rate cut. We're connecting the dots to build a complete map of the financial landscape that's about to shift beneath our feet. We're going deep on the consequences of the Federal Reserve cutting interest rates. So, let's get straight to the facts. The next Federal Reserve meeting is on September 17th. Right now, according to the powerful CME Fed Watch tool, the market is pricing at an 89.3% probability of a 0.25% rate cut. There's only a 10.7% chance they pause. Now, these odds have been swinging wildly, from 59% to 100%, over the past month, showing just how anxious the market is for this. But here's the key takeaway: even if they don't cut in September, their next meeting is in October. The direction is clear. Rate cuts are coming. It's not a matter of if, but when. And that when appears to be very, very soon. This isn't just speculation, it's about understanding the mechanics of the financial system so you can position yourself ahead of the crowd. Let's start with the big one, the stock market. The S&P 500 is hovering near all-time highs. Conventional wisdom might say that's a dangerous time to invest. But history tells a different story when the Fed starts cutting. Let's look at the data from past cycles when the Fed cut with the market this high. 1 month after the first cut, the market is typically flat, even down slightly by about 0.2% on average. It's a period of digestion and uncertainty. 3 months later, the momentum starts to build. The market is up an average of 2.1%. 6 months out, the rally accelerates. Average gains jump to 3.8%. And 1 year later? This is the most stunning part. The market has been up a whopping 13.9% on average. And crucially, it has been positive 100% of the time a year after the first cut. Let that sink in. Every single time in modern history, waiting a year after the first rate cut would have left you with gains. If you're on the sidelines, hoping for a massive crash to buy in, time is mathematically against you. Your best chance for a minor dip is actually in that first month after the cut. But betting against the longer-term trend has been a losing strategy. But why? Why does the market do this? The answer is simple but profound: rate cuts are inflationary. We saw a preview of this just recently at the Jackson Hole Economic Symposium. At the mere hint of a more dovish Fed, what happened? Surged. Silver shot up towards its recent highs above $39 an ounce. Bitcoin and other cryptocurrencies rallied hard. This happens because cutting interest rates is like pouring lighter fluid on the embers of the economy. It makes money cheaper to borrow, increasing the supply of dollars in the system. When you have more dollars chasing the same amount of goods, or in this case, financial assets like stocks, gold, and Bitcoin, their prices inflate. Think of it this way: look at a 30-year chart of gold. Is the value of the metal itself going up? Or is the purchasing power of the dollar you're measuring it with going down? Rate cuts are a direct attack on your dollar's strength. They devalue the currency, and as a result, the nominal price of everything from a loaf of bread to an ounce of gold goes up. We are, in my opinion, entering the early stages of the great melt-up period where easy money fuels and everything rally. Now, let's talk about the bond market, which is the Fed's primary playground. In anticipation of these cuts, bond yields have already started to fall. Why? Because if new bonds will be issued with lower rates in the future, the existing bonds with slightly higher rates become more valuable, pushing their yield down. This has massive ripple effects. Government debt. The U.S. government is the world's largest borrower. Lower rates mean their interest payments on new debt decrease, which is a huge relief for the budget. This is a key reason there's political pressure on the Fed to cut. Mortgages. The 10-year Treasury yield is the bedrock for 30-year mortgage rates. As it falls, so do mortgage rates. We've already seen them dip this year. Cheaper mortgages are a tailwind for the housing market, likely supporting, or even pushing higher, already high home prices. Auto loans and credit cards, see this chart? Rates on auto loans and credit cards are highly correlated to the Fed's rate. While they'll still be high, they should begin to drift lower, easing the burden on consumers. Now, for the bad news if you're a saver. The same mechanism that lowers borrowing costs also lowers the interest you earn. High-yield savings accounts? Rates will fall. Certificates of deposit, CDs? Rates will fall. Money market funds, like SPACs or VMFXX in your brokerage account? The yield you receive is directly tied to short-term rates. It will decrease. The era of earning a safe 5% on your cash is coming to an end. This is designed to push you out of cash and into riskier assets like stocks and bonds to stimulate the economy. It's a deliberate strategy. So, to tie it all together, the Fed is poised to cut. This will likely weaken the dollar, inflate asset prices, lower borrowing costs, and crush yields for savers. And remember, rate cuts are often just the first act. They are typically followed by something even more powerful, quantitative easing, literally creating new money to buy assets. This isn't a short-term trade, it's a major policy shift. It pays to understand the tides so you can swim with them, not against them. If you found this breakdown valuable, smash that like button and subscribe and turn on notifications. I'll be your guide through this entire cycle, keeping you updated on the Fed, the markets, and how to protect and grow your wealth. What do you think? Are you prepared for the great melt-up? Let me know in the comments below. Thanks for watching. Do your own research, make smart decisions, and I'll see you in the next video.